Okay, folks, welcome back. This is the third teaching of a series of 8 for the first month of the ICT mentorship. Okay, we're going to be continuing on our theme of understanding the mindset that you have to have going into the marketplace, looking at things in a little bit reverse order than you're normally taught from a retail perspective. And this is one of those teachings that you're going to have that if you're new, you actually have the advantage here. For folks that have been trading for a while that have adopted bad habits or an understanding or a belief that they have an understanding, it's going to be a little bit expensive for them because they're going to have to purge some of the things that they either subscribe to or wrestle with it until they either do or elect not to use this insight at all. I mapped out a crude depiction here, and I've been using it for months actually as a teaching tool. But we're going to really hammer it down in this mentorship because it's imperative that you know how we as traders are supposed to be viewing marketplace data delivery, reverse psychology, whatever the psychology of this informed money is. It's going to be diametrically opposed to that of the uninformed or speculative money or quote unquote dumb money. And when we have these ideas, when we look at price, okay, the first thing we have to do is establish who is the victim here. Generally there's a victim always in every crime. And the perspective that the speculative uninformed money has is that, number one, they don't acknowledge that there's a smart money. There is not an entity out there that has quote unquote the right things always on, the right perspective, or that a market is rigged or controlled or manipulated or has any influence over long-term price delivery. The uninformed money, okay, or those that are uninformed in regards to how smart money actually operates and exists in the marketplace, their actual perspective really is that indicators are the answer. And uninformed money, their perspective holds the belief that price moves by indicators' influence. Okay, and the influence of an indicator being overbought or oversold, that is what the precursor is to a market moving higher or lower. And I can tell you, I subscribed to that for years as a new trader, and it took a long time for me to actually be broken away from that type of mindset. So if you're new and you haven't been exposed to indicator-itis and you're not infected with that yet, you're actually pretty good in terms of advantage. Those that like to use indicators are going to have a little bit of a struggle with this mentorship because I'm telling you, basically, you need to get that out of your system, get that off your charts, because it is not how you're going to be able to see smart money. In fact, we're going to be able to use these indicators to be informed as to what the uninformed traders are actually thinking. So when we talk about sentiment next month, you'll have a lot more understanding about what that is, how it's developed, and what you can do with it. Now, obviously, we only exposed one side of the paradigm here by specifically dealing with the speculative uninformed money's perspective. You're not here to really so much learn about those individuals, because obviously we all know that there's a losing crowd in the marketplace, and your idea of being a part of that group is foolish. So we're here only to focus on what the smart money view is on the marketplace. And that begins by understanding that there is a huge, vast, enormous new pool of liquidity coming into the marketplace every single day. Even though there's new busted accounts all the time, the statistics tell us that 90% of traders lose their money. Large funds are in the same category. Not every fund is profitable. Just because there's a lot of people that are investing money into this fund or this fund manager does not in no way guarantee that that fund will exist a year, 2 years, 5 years from now. So we, as informed traders, our perspective is to hold the perspective of what a liquidity provider or smart money view is on the marketplace. And they put a spotlight on the aspects of uninformed money, because that's what makes the world go around in the marketplace. The smart money is there to provide liquidity, but they're doing it at a exchange premium. In other words, they're putting in trades that they're going to most likely come back to either offset or neutralize for their interests. And we're going to talk more about that as we go. But for now, understand that the smart money knows, in fact, that there is a large body of uninformed money out there. Contrast that with what we spoke of concerning the uninformed money's perspective, is there's a lack of an entity out there that has a smart money perspective on the price. They don't have an opinion or an idea-based perspective that there is someone or some entity or entities out there that have a smart money perspective, or that the banks would actually trade against large firms or funds. That goes against the grain of what a free market is. So when we have a smart money perspective in the marketplace, we actually use their perspective as everybody else's liquidity. And price is delivered to engineer efficiency for the smart money entities only. It's not anything outside that. So to hold the perspective of a liquidity provider, you are adopting a smart money perspective, and everybody else is liquidity. And the liquidity is going to be in the form of buy stops, sell stops, pending orders above and below the market highs that are most recently formed on your charts. Once we understand that there's two distinct perspectives, that's what creates the market efficiency paradigm. Both groups, okay, have their individual perspectives. The one that is smart money, they have the unique perspective of understanding already what the uninformed money is going to believe about the marketplace, and that gives them their edge. On top of that, they're actually in control of price. Just like anything else, if you own a storefront or if you own a business and your commodity is sold, who sets the price for that commodity? You're the store owner. Well, currency is owned by the bank, and they set the price on the value of that bank note or that digit on your screen that says you have XYZ number of dollars in, or francs or pounds or whatever it is that you're measuring your currency in. That value is set by the central bank that has printed that money. And why this is such a speed bump for people's understanding is beyond me, because if you look at the state of the world we're in right now, obviously corruption and deceit is the name of the game. So it's not a shock to hear, if you first time being exposed to this, that the central banks are in absolute control of what their price of their currency is, and they can set it at any time at any price they want. Don't believe me? Look at what they did with the Swiss franc and the euro when it was depegged. Instantaneous wipeout. Okay. So once we understand both perspectives, okay, intimately, okay, we no longer have a at odds perspective on the marketplace. We don't vilify the market maker. We don't vilify smart money. We don't beat up or make fun of the uninformed money. In fact, what we do is we find a balance in between that. And we don't think in terms of victim or aggressor. We just think in terms of efficiency, because the markets are always going to trade in an efficient manner, but it's slanted and more prone to lace the pockets of the smart money, because they have the advantage of pricing wherever they want price to go to, and they already know what the perspective is of the uninformed money, and they also know how to manipulate that perspective at any given time based on chart patterns, based on indicators, based on just reactions to the market news.